Welcome to the deep dive. Today we're jumping straight into something really, really crucial for your financial well-being.
Yeah, we're talking about emergency funds.
Exactly. We've looked at some great podcast excerpts specifically on this topic.
And our goal today is pretty straightforward, right?
Right. We want to cut through the noise, distill the essential stuff you need to know for your financial security.
Like what an emergency fund actually is, why it's so vital, not just nice to have.
It definitely not just nice to have. And, how much should you aim for? Where do you keep the money?
And the big one, how do you actually build one, even if maybe you're starting from zero?
Yeah, we're drawing out the key takeaways from the sources. Think of this as, like a quick guide to the bedrock of...
It's not about getting bogged down in, complicated theories.
No, definitely not.
It's about understanding the core actions, the things you can actually do that make a real difference in how secure you feel, especially when life, throws you a curveball.
Okay, so let's unpack that first big idea. Because the source material, it dives right in. What is an emergency fund? And why does it matter so much?
Well, at its heart, it's actually pretty simple. But surprisingly, so many people overlook it. It's money set aside only for unexpected, unavoidable expenses.
Okay, unexpected and unavoidable. Both are key.
Absolutely. It's not just, any savings pot you have lying around.
And the examples the podcast gave were, super relatable. Things that just hit you out of nowhere, right?
Exactly. Like your car suddenly needs a massive repair. Something you just didn't budget for.
Or a surprise medical bill. Ugh, those are never fun.
Tell me about it. Or, maybe the biggest one, facing an unexpected job loss. That's a huge potential hit.
Yeah. And the sources, they draw a really clear line here, don't they?
Oh, definitely. This money is absolutely not for that vacation you're dreaming about.
Or that new phone that just came out.
Nope. Not even for, say, a planned kitchen upgrade, unless, your oven suddenly died right before a major holiday. It's got to be critical and unexpected.
Right. It's your, oh crap, the water heater just burst fund.
Precisely. And this is where it gets kind of serious, maybe even a bit alarming.
Yeah.
Because the consequence of not having this specific safety net, it almost guarantees you end up in debt.
That makes sense. Suddenly that, say, $1,000 car repair, it goes straight onto a high-interest credit card.
Exactly. And that turns a temporary problem into, a long-term financial headache.
And there was that statistic in the material that really jumped out.
Oh, yeah, the one about Americans and a $1,000 emergency.
Yeah, over 60% couldn't cover a $1,000 emergency without going into debt.
60%. I mean, just pause and think about that for a second.
It really underscores why this is so foundational. It's not some, advanced financial trick.
No, it's basic resilience, basic stability.
Not having it just leaves you so vulnerable. It's really about buying peace of mind, isn't it?
Absolutely. And that vulnerability, well, it leads us straight to the next big question the sources tackle.
Which is,
how much is actually enough? How do you figure out the right size for this safety net?
right, the big how much question. You always hear that standard advice,
The 3 to 6 months of living expenses thing.
Exactly. Save 3 to 6 months of your essential living costs.
Which, let's be real, if you're just starting out or things are tight, that can sound completely impossible.
Totally. Like trying to climb Mount Everest in flip-flops, it feels overwhelming.
And this is where the podcast insights get really practical and, frankly, encouraging.
Okay, how so?
They strongly recommend starting with a much, much smaller initial goal. Something manageable.
Like what?
Just $1,000. Focus on hitting that first. It's an achievable first milestone.
Ah, okay. I like that. So it's not all or nothing.
Not at all. They call it the ladder approach. It's kind of genius psychologically.
A ladder approach. Tell me more.
You build momentum. Hit that $1,000 first. That's rung number 1. Get that win.
Okay, that's good.
Then your next target is maybe 1 full month of your essential expenses. Rent, food, utilities, transport. The absolute must-haves.
Right, so you calculate that number and that's rung 2.
Exactly. And then, once you've got that 1 month covered, you start working your way up gradually towards that bigger 3 to 6 month goal.
That breaks it down nicely. Makes a huge goal feel less. Huge. More like powerful, confidence-building steps.
Precisely. And where you land on that 3 to 6 month scale, well, that depends.
On your personal situation. Right.
Totally. If you have a super stable job, low expenses, maybe predictable income, you might feel okay closer to 3 months.
But if you're, say, a freelancer with income that goes up and down.
Or if you have dependents or maybe high deductibles on your insurance, You probably want to aim closer to that 6-month mark, maybe even more, for extra peace of mind.
So the target number itself is personal. It's based on your life, your risks.
Absolutely. It's about what helps you sleep at night.
Okay, that makes sense. So you've got a target, whether it's the first okay or you're building towards the bigger goal. Where do you actually put this money? That seems critical.
Ah, yes, the where to keep it puzzle. It's a bit of a balancing act, according to the sources.
How so?
Well, you need it accessible, right? When a real emergency hits, you need the cash, like now.
You don't want it too accessible.
Exactly. You don't want it sitting in your checking account where it's easy to accidentally spend on, I don't know, pizza or concert tickets. It needs some separation.
So what's the recommendation then?
The strong advice, consistently across the material we looked at, is a high-yield savings account.
Okay, high yield, so earns a bit of interest.
Yeah, not a ton usually, but better than nothing. And the crucial part, keep it separate, like in a different bank maybe, or at least a totally separate account from your everyday checking.
That separation feels important mentally too.
It really is. It creates just enough friction. You have to consciously log in, make a transfer. It makes you pause and ask yourself, okay, wait, is this really an emergency?
That little pause could save you from dipping into it unnecessarily, and the high yield part is just a nice bonus while it sits there.
Exactly. Now, what's also really interesting is the very clear advice on what not to do with this money.
Oh, like what?
Don't put your emergency fund into volatile investments, like stocks or crypto or anything like that. They're quite firm on this.
Okay, and the reasoning makes sense, right? It's about risk.
Totally. The stock market, as we know, goes up and it goes down, sometimes way down.
And if your emergency hits when the market's having a bad week or month,
you could be forced to sell your investments at a loss just to get the cash you need. Your $5,000 emergency fund might only be worth $4,000 when you desperately need the full amount.
ouch, that defeats the whole purpose of a safety net.
Precisely. The golden rule for this money, highlighted again and again in the sources, is liquidity, easy access to cash, without the risk of losing value right when you need it most.
Liquidity. Got it. Okay, so we've covered the what, the why, the how much, and the where. Now let's tackle what feels like, for many people, the biggest hurdle.
The how to actually build it, especially if money feels tight already.
Yeah, exactly. How do you make it happen, practically speaking?
This is where the sources offered some really great concrete strategies. The first one, and often the most powerful, automate it.
Automate your savings. Okay.
Yes, set up an automatic transfer from your checking account to that separate high-yield savings account.
When should you do it?
Ideally, like the day after you get paid. Treat it like any other bill,
Even if it's a small amount.
especially if it's a small amount. The sources really emphasize this. $10 a week, $25 a week, whatever you can realistically manage right now. Consistency is the magic ingredient here.
So you build that cushion over time without having to think about it constantly or rely on willpower every single paycheck.
Exactly. You sort of pay yourself first for your future security. It just happens in the background.
Okay. Automation is key. What else?
They also suggest looking for small wins,
Yeah.
like actively finding little pockets of extra cash you can then redirect straight to the fund.
Small wins? Like what kind of things?
Could be anything, really.
Yeah.
Selling stuff you don't use anymore, clothes, electronics, furniture. Go through your subscription streaming services. Apps be ruthless. Cut what you don't truly need.
And use cashback apps or browser extensions when you shop online.
Yeah, things like that. The key is, when you find that extra $15 from selling an old book, or save $10 by canceling a subscription, don't just let it disappear to your regular spending. Immediately transfer it to the emergency fund.
Makes sense. Channel those small amounts purposefully.
There was also mention of gamifying it, making it kind of fun.
Gamify saving.
Well, you could try a no-spend challenge for a week or a month. See how much you don't spend compared to usual, and transfer that amount.
Or that trick of saving every $5 bill you get in chain.
Exactly. Little games like that can make it feel less like a chore and more like, well, a game you're trying to win.
I like that. Takes the pressure off a bit.
And one more really powerful strategy they highlighted. Prioritize windfalls.
Windfalls.
Yeah.
Like unexpected money.
Yeah. A tax refund, a work bonus, maybe a small inheritance, even a cash gift for your birthday.
Okay, what do you do with it?
Treat your emergency fund as the first thing that gets paid from that windfall. Before you think about spending it on anything else, carve out a chunk, maybe even all of it if your fund isn't full yet, and send it straight there.
Ah, so you use those bigger injections to give your fund a significant boost that could speed things up considerably.
Absolutely. It can really accelerate your progress towards that $1K goal or the bigger targets.
Okay, great practical tips there. So let's say you're building the fund, you're making progress, that's awesome. But knowing when it's okay to actually use it seems just as important.
Oh, absolutely critical. This money has a very specific um, job description.
And the sources were really clear on this, right?
Crystal clear. This fund is only for genuine, unexpected crises. You have to guard it, like fiercely.
So let's reiterate those valid uses. What counts as a true emergency?
Things like urgent medical bills that aren't covered by insurance or high deductibles, truly necessary and unexpected car repairs, like the transmission fails, not just routine maintenance.
Okay, what else?
Maybe urgent travel needs a family emergency you couldn't plan for. And of course, covering your essential living expenses if you suddenly lose your job and income stops.
Right, things you absolutely cannot avoid paying for and that you couldn't have reasonably budgeted for in advance.
Exactly. And just as important is understanding what it's not for.
Okay, lay it out. What's off limits?
Definitely not for impulse buys, even if something's on a massive sale.
So that 50% off TV doesn't count.
Definitely not.
Yeah.
Not for concert tickets, not for vacations, not for down payments on things you want, but don't need urgently.
They also mentioned guarding against lifestyle creep.
Right, that's a big one. That's when you start thinking, oh, I've got this cushion, I can afford this little extra thing. No, it's not extra spending money. It's disaster aversion money. Using it because you feel like you deserve a treat, rather than because a true, unavoidable emergency happened. That defeats the purpose.
That clarity is so vital. Protecting the fund is paramount. It's your shield, like you said. Using it for anything less just leaves you vulnerable again when the real emergency hits.
Exactly. The discipline in protecting the fund is just as important as the effort you put into building it in the first place.
Okay, so let's try and bring this all together. If we distill the core message from these sources.
It seems to be that an emergency fund isn't just like a financial product you might have. It's foundational. It's your first layer of real financial security.
It's the safety net, the thing that stops an unexpected cost from completely derailing your entire financial life, sending you into that debt spiral we talked about.
Yeah. And the key steps to get there are pretty actionable, really.
Right. Start small. Don't get intimidated by the big numbers. Aim for that first $1,000.
Automate your savings. Make it consistent. Make it happen without relying on willpower.
Look for those small wins. Find extra cash. Use windfalls wisely.
And, critically, protect that fund. Know what it's for and what it's not for. Treat it like the essential insurance policy it is.
And quantifying the impact of consistency, that was powerful too. You mentioned even just $10 a week.
Yeah, $10 a week. It sounds small, maybe insignificant, but that's over $500 in a year.
Wow, that actually adds up.
It really does. Small, consistent actions build significant resilience over time. It proves you can do it.
So the action steps suggested, they're pretty concrete things anyone listening could potentially do, like right now or this week.
Absolutely. Step 1, open that separate savings account. Preferably high yield, definitely separate. Give it a name like emergency fund or freedom fund.
Step 2, set up that automatic transfer. Even if it's just $5 or $10 to start, just get the habit going. You can always increase it later.
And step 3, track your progress. Watch that balance grow. Maybe make a little chart. Celebrate the milestones, hitting $100, $500, that first $1,000. Acknowledge your effort.
Because every single dollar you intentionally put into that fund,
It's buying you something incredibly valuable. It's buying peace of mind.
freedom from panic when a crisis hits.
Less stress in your daily life, knowing you have that buffer. Resilience.
Yeah.
It really does buy you options.
This has been a really crucial deep dive, getting a handle on building that financial safety net. Thanks for joining us as we unpacked these essential steps.
My pleasure. It truly feels like a non-negotiable piece of the financial puzzle for long-term stability and well-being.
Absolutely. And, as you're listening, think about how vital the safety net is for handling crises, for gaining that peace of mind we talked about. Here's maybe a final thought to ponder.
Okay.
What new opportunities or maybe what new levels of freedom might building this fund actually unlock for you in your everyday life, beyond just weathering the storms?
Interesting angle. Like, what else does it enable?
Yeah. Could having that cushion give you the confidence to, say, negotiate harder at work? Or maybe consider leaving a job you really dislike, knowing you have time to find something better?
Or the freedom to pursue a new skill? Take a calculated risk on a side project.
Exactly. Or maybe just free up the mental energy that's currently being consumed by financial anxiety. What could you do with that freed up headspace?
That's a profound question, actually.
Yeah.
Thinking about the ripple effects of feeling financially secure beyond just the emergency itself.
Something to think about. Indeed. Well, we look forward to our next exploration together.